Your credit score was never designed to measure how good you are with money. I know that sounds wrong. You've been told your whole life that this 3-digit number is your financial report card. Pay your bills, stay responsible, and the number goes up. But then you pay off a loan completely, and your score drops. You close a credit card you never use, and it drops again. You do everything a responsible adult is supposed to do, and the number punishes you for it. So what's going on? Here's the truth nobody tells you. The credit score is a report card, yes, but it's written by the casino. And it's not grading how responsible you are, it's grading how profitable a gambler you are. Once you see the score that way, every single one of its bizarre rules suddenly makes perfect sense. And by the end of this video, you'll know exactly which moves actually push the number up fast, and which responsible moves quietly drag it down. Let's break the whole game open. Start with where this thing came from. The score most lenders use is the FICO score, built by a company called Fair Isaac, and the modern version rolled out in 1989. Notice who their customer is. It's not you. You didn't hire FICO. Banks did. Lenders wanted one question answered. If we lend this person money, will we get paid back? With interest? That's it. The score is a prediction machine, and the main thing it's built to predict is your odds of falling seriously behind on a payment, roughly 90 days late, within the next couple of years. Therefore, the score doesn't care if you're wealthy. It doesn't care if you have savings. It doesn't even care if you hate debt. A millionaire who pays cash for everything and has no credit accounts can have a worse score than a broke college student with 2 credit cards. Sounds insane, right? But it's not insane to the casino. The millionaire generates 0 data and 0 profit. The student is a known, trackable, interest-paying customer. The house grades the players it can actually make money on. Now let's use that lens to solve the 2 mysteries that frustrate people the most. Mystery number 1. You close a paid-off credit card and your score falls. You thought you were tidying up, but here's what the scoring model saw. About 30% of your FICO score is amounts owed, and the biggest piece of that is something called credit utilization. That's your total balances divided by your total credit limits. Say you have 2 cards with a $5,000 limit each, and you carry a $2,000 balance on one. That's $2,000 out of $10,000 available, 20% utilization. Not bad. But then you close the empty card. Now it's $2,000 out of $5,000, 40% utilization overnight. You didn't borrow a single new dollar, but on paper you suddenly look twice as maxed out. Therefore, the model marks you as riskier, and your score drops. There's a slower cost too. Closed accounts in good standing eventually fall off your report, generally after about 10 years. And when they do, they can shrink the average age of your credit history, which is another thing the score rewards. The responsible move hurt you because the score was never measuring responsibility. It was measuring how you look as a bet. Mystery number 2 is even more brutal. You pay off a loan, a car loan, a student loan, completely. Final payment, done, free, and your score dips. Why would the system punish you for finishing? 3 reasons, and they all make sense through the casino lens. First, that loan account closes, and an open account that's being paid perfectly every month is one of the strongest positive signals you can feed the model. You just switched off a machine that was printing good data about you. Second, about 10% of your score is credit mix. The model likes seeing you juggle different types of credit, both revolving credit like cards and installment loans like car payments. Kill your only installment loan and your mix gets thinner. Third, the model actually rewards you for having a small remaining balance compared to the original loan amount. And the moment the loan hits 0, that reward disappears. Read that again. You are literally scored better while you still owe them something. Because a borrower with no debt isn't a customer. The casino doesn't hand out trophies to people who leave the table. So if the score isn't grading your character, what exactly is it grading? Here are the 5 factors of a FICO score ranked by real weight. And I want you to hear each one the way a lender hears it. Number 1, payment history, 35% of the score. The lender translation? Does this person reliably send us money on time? This is the single biggest factor, and one late payment that hits your report, usually once you're 30 days past due, can knock a good score down dramatically and haunt it for years. Number 2. Amounts owed, 30%. Translation: how close is this person to their limit? How desperate for credit do they look? This is the utilization game we just talked about. Number 3. Length of credit history, 15%. Translation: how long is the track record we're betting on? Longer data, safer bet. Number 4. New credit, 10%. Translation: is this person suddenly asking everyone for money? Every formal application triggers a hard inquiry, and a burst of them makes you look thirsty for cash. Number 5. Credit mix, 10%. Translation: can this person handle multiple types of products we sell? Look at that list again. Not one of those 5 factors asks about your income. Not one asks about your savings, your investments, or your net worth. The scoreboard tracks one thing: how you behave as a borrower. Because that's the only version of you the casino can bill. All right, now the part you actually came for. What actually moves this number fast, and what's a complete myth? Let's kill the myths first, because they're costing people real money. Myth 1. Checking your own score hurts it. False. Checking your own credit is a soft inquiry, and soft inquiries don't touch your score at all. Check it every single day if you want. The hard inquiries, the ones that can shave a few points off, only happen when you formally apply for credit. Myth 2, and this one makes me genuinely angry. You need to carry a balance to build credit. This is the most profitable lie in personal finance. Carrying a balance does nothing for your score, nothing, and it charges you interest that can run north of 20% a year for the privilege. What builds your score is the account being open, active, and paid on time. Pay the statement in full every month, and the model sees exactly the same on-time payment either way. Ask yourself who benefits from you believing that myth. Then remember who wrote the report card. Now the real levers, the ones that move the number in weeks, not years. Lever 1. Crush your utilization. Your balances get reported to the credit bureaus roughly once a month, usually around your statement closing date. Therefore, utilization has almost no memory. Pay a maxed out card down before the statement closes, and the improvement can show up in the next cycle, often within 30 to 45 days. Aim below 30% of your limits, but the sweet spot is under 10%. Lever 2. Raise the other side of the fraction. You can lower utilization without paying anything extra, just by asking your card issuer for a credit limit increase. Same balance, bigger limit, lower percentage, higher score. Lever 3. Hunt for errors. Studies by the Federal Trade Commission have found that a meaningful chunk of consumers have errors on their credit reports, and some of those errors are big enough to change what people pay for loans. You can pull your reports for free at annualcreditreport.com and dispute anything that's wrong. Deleting one false late payment can do more for you than a year of perfect behavior. Lever 4. Become an authorized user. If someone you trust has an old card with a perfect payment history and low utilization, being added to it can graft their good data onto your file. You don't even need to touch the physical card. And lever 5 is the boring one, but it's the 35% one. Automate your minimum payments so a missed due date is literally impossible. You can always pay more manually, but you can never unring the bell of a 30-day late mark. So let's land this plane. The credit score is not a measure of your worth. It's not a measure of your discipline, your intelligence, or your future. It's the casino's internal rating of how profitable and predictable you are as a player. And here's the twist that changes everything. Once you know that, the rigged-feeling game flips in your favor. You stop playing to be responsible and start playing to feed the model exactly the data it rewards. On-time payments, low utilization, old accounts, few applications.
Do that, and the casino hands you its best odds, the cheapest mortgage rates, the best card offers, the lowest cost of borrowing available. You use their scoreboard to take their money. That's the whole game. If this reframed how you see that number, hit subscribe. Because on Mr. Money Boss, we don't just follow the rules of money, we read the fine print on who wrote them. So no, your credit score never measured how good you are with money. It measures how good the bank thinks you'll be for theirs. And now you know how to ace a test you were never supposed to understand.